Yes, hello everyone. I'm sure you're doing great. Energy levels are super duper high, and the excitement levels are also very high because we are at day 2, the final day of your tax syllabus revision. 100% for the full syllabus for your March 2026 exam attempts. So here I am taking up the remaining topics that were not covered yesterday that we are covering today. Before we go further, guys, can you give me a quick chat, a quick revert, whether am I perfectly audible or not? So what is the status? Just tell me, please. Is my video clear? Is my audio completely audible to you? You can hear me clearly with no glitch. Just comment back in the chat box quickly. Yes or no? So would be much appreciated. Okay, now thanks. Now let's begin with the session. So quickly having a look at what we covered yesterday in the day 1 of your tax revisions and what are the topics that we are going to cover today. So precisely we covered these all topics in your day 1 revision yesterday, and people who are joining today but they were not out, they have not gone through what we covered in day 1, then I request you to please go back, look at the video which is there in my ACCA tax and ATX playlist. Please have a look at that video, complete that revision portion as well. Now today we are on day 2. Day 1 topics that we covered were basic taxation concepts, income tax calculations, residency rules, employment income, NIC, national insurance contribution, pensions, property income, trading income, assessable trading income, capital allowances, losses, chargeable gains, losses for the losses in case of chargeable gains, and how do we treat the capital losses. No, groups we did not cover. And then we covered the self-assessment, not exactly, but I gave you a brief up that look, I have that Excel file or I have that PDF created for you all. So please go through the same. I repeat it again, guys. If you have not got the copy of your PDF, then please get it from my Telegram channel, which is absolutely free, and its complete summary notes are over there, right? So it is really going to help you a lot in your revision. Then we also covered shares and securities. So precisely we covered everything till this point, and now we are on day 2. In case if you have any questions and queries, you know that you can always put those queries to me in the chat box. So all of you, please put your queries to me in the chat box. Now I begin with the day 2 session, and the topic that we are going to cover today is extremely important, and the topic that generally troubles students is IHT, inheritance tax. Then we will be covering corporations, that is TTP, the total taxable profits calculations. Again, for the corporations, we will be covering the tax calculations, the chargeable gains calculations, that is the shares and securities angle we'll be covering. We'll be covering for the corporations the losses treatment, how do we treat those losses, and the group adjustments, also group reliefs as well. Post which then we will complete VAT. So this is the entire topics that we are going to cover today, and day 1 and day 2 combined will give you 100% revision of your tax syllabus and will make you completely tax ready. Okay. Now, also one more point, guys. If you have not till now like the video or subscribe to my channel, then please do that so that you have updates of all the upcoming more videos that are going to come to you at least till this exam week. Okay, so keep focused and stay tuned for this. Now let's begin with the first topic, with the full on energy, people, with the full on energy. So let's have the first topic, and my first topic is IHT. So I'll quickly share the screen and we will be doing the IHT here. So I'll take you to IHT. Yes. Now, inheritance tax is a topic that is certainly you can expect for sure when you are whether you are doing a section C question and a 10-mark scenario. Inheritance tax is one of the most favorite topics. Section B questions, when you do, you can have a case where you have a combination of chargeable gains and IHT asked. Section A, where you'll have multiple questions asked from IHT. Okay, now for having more details about how are the questions asked and how do we answer them, I have also uploaded full 100% full debrief of the pre-March tax mock for section A, for section B, and I'm going to be uploading section C also. So please go through the same and you'll have complete hold of how to do these questions, what are the pointers to be noted, and how to go about them. Now, let's go back to the concepts. So here we are doing inheritance tax, and let's go to the concepts quickly. Now, first point, inheritance tax will apply when? So it is applicable at 3 instances. And which are the 3 instances? The first instance is at the time of lifetime of the donor, at the time of death of the donor, and at the time of death only we will have 2 times taxes calculated. Okay, now first let me give you a background about what is inheritance tax. Inheritance tax is a tax that is being applicable when a person gifts out of love and affection to another person or to a trust. Only these 2 categories, to another individual or to a trust. And if these gifts are made during lifetime, then we have 2 taxes applicable. One is a lifetime tax, that is when during the lifetime a donor is transferring the asset to the donee. So during the lifetime we'll have lifetime tax calculated. Second is on the same lifetime tax based upon a condition, we will calculate death tax upon the death of the donor. Third is when the donor passes on the assets or to the other beneficiaries, or when the donor passes on these assets to the other receivers as a part of his will, as a part of his estate, then we have IHT calculated on the death estate. Done and clear? Okay, now let's go further and let's discuss more. So now we know inheritance tax is calculated at 3 pointers. Number 1 as lifetime tax during the lifetime of the donor, on the lifetime transfers, then again on the lifetime transfers death tax may apply. Third is IHT on death estate, that is when the taxpayer dies and the assets are passed on as a part of his estate. Okay, now let's first cover what are lifetime transfers. So number 1, lifetime transfers are those transfers that are made out of love and affection from one individual to another individual or to trust during the lifetime of the donor. Before that, so when we take the lifetime transfers, we need to get the value. Either the transfer of value will be given to you in the question. TOV we call it, because this is known as transfer of value. Okay, it will be given to you in the question. If it is not given to you, then you calculate, and you will calculate it by following the method which is diminution in value method. Diminution in value simply means what is the loss that has taken place as a result of the gift which is made, as a result of the transfer. Typically, like in the case of shares, when the shares are transferred, so what is the loss that is there? So that loss we call as diminution in the value. Clear? Now, lifetime transfers are 2 types. One is a potentially exempt transfer. Another is a CLT transfer that we call as chargeable lifetime transfer. I'm sure you can see the screen. On my screen, everything is visible. So just keep following my screen with it. Okay. Now, in case if you have any questions, queries, anything, ask me like million times in the chat box. Okay. Ask me million times. Now, so let's take it further. Now, what is a potential exempt transfer? PET transfer is a transfer which is simply made between an individual to another individual. Clear? What is a CLT transfer? It is a transfer that is made between an individual to a trust. Done? Clear? Great. Okay, now, so what is the difference between these two transfers? The beauty here is individual to individual transfer, which is PT transfers. When this is made during the lifetime of the donor, then it is subject to zero IHT. That means IHT is not calculated when the lifetime transfers are made while the donor is alive. No IHT will be calculated on it. But when it comes to CLT transfers, the chargeable lifetime transfers, which is made between an individual to a trust during the lifetime of the individual, it is subject to IHT. And the tax rate of IHT is at the rate 20%. Okay, at the rate 20% if the tax is borne by the donee. And it is at the rate 20 by 80, or we calculate 25% if the tax is borne by the donor. Okay, if the tax is borne by the donor, remember you have to multiply 25% or 20 by 80. When the tax is borne by the donee, you will multiply 20%. Okay, clear? Now the next point is, ma'am, on what value should we calculate this? On what value should we calculate? So you would always do the calculation on this value, which is your starting point is transfer of value. That is simply the value of the gift. Now from this, you're allowed to reduce certain exemptions. Which exemptions you're allowed to reduce? Number one, spouse to spouse transfer or civil partner to civil partner transfer is exempt under IHT. So whether the person dies or is alive, it will never be subject to IHT. Okay, that is a spouse exemption. Number two, if there is marriage of a donee is taking place, let's say my friend's daughter is getting married, I am going to give to her on occasion of marriage. So up to 1,000 that I am giving to my friend's daughter on the occasion of marriage will be exempt for me. Up to 1,000 of the value of the gift. Okay, only up to 1,000. Now if a parent is gifting to their children on the occasion of marriage, then up to 2,500 is going to be exempt. Up to 5,000 is going to be exempt. If the grandparents, the great grandparents, and the lineage above is giving gift to their children, to their grandchildren, great grandchildren on the occasion of marriage, then exemption is up to 2,500 per person, per bride, per groom, like that. Okay. Then if the gift is made by any other person, the limit is only up to 1,000, whether it's a brother, sister, uncle, aunt, whoever is gifted. Now the next is, let's say that if bride and bridegroom are gifting to each other, then the exemption limit is up to 2,500. Got it? Clear? So 5,000 for parents, grandparents and all 2,500, bride to bridegroom, bridegroom to bride 2,500, any other person 1,000. Remember it always. Now let's move further. So now we have done about marriage exemption. We have done about the spouse exemption. Next is, that is, if let's say there's any trivial benefit exemption, which is not trivial benefit exemption, we call it a small gift exemption. Small gift exemption is when the gift is made of very trivial amount to any number of persons is okay. So per person up to 50 pounds in a year is allowed as a deduction, as an exemption. Okay, so in a tax year, gift value up to 250 pounds, not 50, 250 pounds per donee is allowed as a deduction. 250 pounds per donee. Clear? So now we know small gift exemption. Now we know the marriage exemption. We know spouse exemption. Now next one is normal expenditure out of income. So when let's say a person is giving money to the other person for normal expenditures like normal day-to-day activities expenditure, that is exempted. Last is annual exemption. Annual exemption is for the tax year wise. For the current tax year, you will get 3,000 as the maximum annual exempt amount, and the preceding tax year balance, anything remaining for annual exemption can also be carried forwarded to the next tax year, only to one tax year only. Let's say the question says that the gift is only made in the current tax year. The last year there was no gift, so then last year's 3,000 of amount of annual exemption will also be made available to you. Okay, so current year annual exemption and the preceding year annual exemption both will be made available to you. Clear? Done. One point is very important. Now, when we adjust annual exemption, it will be adjusted against the gifts that are made in the same order in the tax year. For example, if we made a gift, let's say on 10th April, I made a PET gift. On 20th May, I made a CLT gift. Okay, now when I'm adjusting annual exemption, I will adjust first against the PET transfer of value, and then only anything remaining will be adjusted against CLT. It doesn't matter even if PET is exempt during lifetime. Done? Clear? So we have done all the exemptions. So now when you adjust exemptions, you will get a chargeable transfer of value. And from this, then you will reduce NRB. NRB is nil rate band. Nil rate band is for your tax year is 325,000. That means from this value you will reduce this NRB, which is 325,000. Okay, this is available gift on gift basis. It is not annually available. If I have made 10 gifts in the tax year, I will adjust NRB against all the 10 gifts individually. There is just one rule that you need to remember. When you adjust nil rate band, you have to reduce from this NRB of 325,000 the gross chargeable transfer of value that we will just cover in just 2 minutes. GCT, that we call as gross chargeable transfer of value of the transfers made of the chargeable transfers made in the 7-year period prior to the date of gift. That simply means, let's say my date of gift is 10th October 2024. Then please see the 7-year period. It will start from 11th October 2017 and it will go on till 10th October 2024. Okay, so now for this period, if there is any chargeable transfer made in a lifetime, the chargeable transfer will be what? CLT transfers. Clear? So if there is in this 7-year period, if there is any chargeable transfer made, which is like the CLT transfer, so then within this period, we will take the GCT of that transfer and I will reduce my NRB by it. If there is no GCT made of any chargeable transfers and there are only PET transfers which are exempt during lifetime, then I will have full NRB to be adjusted, and accordingly, after we adjust NRB, I will get here taxable value. On that taxable value, finally we apply IHT. So if the tax is borne by donor, you know that if the tax is borne by donor, then the tax rate is 25% or 20 by 80 of the taxable value. If the tax is borne by donee, then what do you do, guys? If the tax is borne by donee, then simply the tax rate you will apply 20% on the taxable value. Now comes the next point, ma'am. What is GCT? GCT is the gross chargeable transfer of value. Remember, if a tax is borne by donor, then the GCT will be equal to your chargeable transfer of value plus IHT paid by the donor. Chargeable transfer of value is this value, which is before NRB. If the tax is borne by donee, then it's simple. It is just chargeable transfer of value and you will not add IHT. Done and dusted. Clear? So a lifetime tax, I will explain you also with the question how do you calculate it. Don't worry. So we know the performer now and it is to be followed in the same way. Start with transfer of value, write the exemptions, whatever is to be reduced. Typically, most commonly, you will find the annual exemptions only that will be reduced, most commonly. Okay, and then you reduce exemptions, you get chargeable transfer of value, reduce NRB, but don't forget to reduce from NRB GCT of the chargeable transfers made within 7 years prior to the date of gift. And then you get your taxable value, on that you apply IHT. Done? Very clear? Okay, let's move on to the next one. So this is the entire thing that you need to know about the lifetime taxes, nothing else. Lifetime IHT. Now we will calculate the next one, which is death IHT on the lifetime transfers. So how do we calculate death IHT on the lifetime transfers? I will just explain here. And the others who are there with me in the session, you have any doubts and queries, quickly put up in the chat box. And also guys, if you think you like the video, if you think this video is helping you in your revisions, please do write your feedback in the comment section also. That is going to be, giving me a feedback, whatever your feedback is, that how the session went, did it really prove to be helpful for you? That is the purpose for which I am doing this session. Okay, now let's go to the next one. Yeah, next we are doing death IHT on the lifetime transfer. This is the second time when you with this, or this is the second tax point. First was lifetime transfers, lifetime IHT. On the same lifetime transfers, now we will calculate death IHT. If you need to know detailed on this death IHT, I have created a detailed video on this death IHT only, and that is available on my channel in my playlist tax and ATX. Please do go through the same. Now, death IHT, we know that it is also calculated on the lifetime transfers. The only thing is, death IHT will only be calculated on those lifetime transfers, be it PET or CLT, doesn't matter. The transfers that took place within 7 years prior to the date of death. So if your death took place on, let's say 31st December 2024, go back 7 years, and your period will start from 1st January 2017 onwards. So 1st January 2017 onwards till 31st December 24, any PETs or CLTs that took place will be subject to death tax. So what you will do, your starting point will be the GCT that we just calculated. Now from GCT, what you will do, again you will get another NRB to be reduced. Yes. So from this GCT, again you will reduce NRB. Same rule, that is from 325,000 you will reduce NRB that took place, you will reduce the GCT of the chargeable transfers that took place okay, so that chargeable transfers that took place within 7 years, same definition, prior to the date of gift. Okay, so GCT of the chargeable transfers that took place within 7 years prior to the date of gift. Done? Clear? Okay, now we know GCT, we know NRB, we will reduce it, and you will get here again taxable value. Yes, again you will calculate IHT here, but now here at the time of death tax, your IHT is not 20 or 25%. It is at the rate 40%. Since the taxpayer has died, it is going to be borne by the donee only. You will calculate IHT at the rate 40%. Now, if it is a CLT transfer that is falling in the 7 years period on which you are calculating that IHT, so then you will reduce the lifetime tax that you have already borne. Otherwise, it will lead to double tax, right? So lifetime tax on the CLT transfer only, because PETs never was subject to lifetime tax. And if that PET transfer is falling in the 7-year period prior to the date of death, then it becomes a chargeable transfer only. So from NRB, when I reduce the GCT, I will reduce the GCT of that PET transfer also that took place in 7 years prior to the date of death. Clear? Right? Or once it took place in 7 years prior to the date of death, it becomes a chargeable transfer. And that chargeable transfer will reduce NRB if it is falling in 7 years prior to the date of gift. Very important to understand this. Now you will reduce your lifetime tax here. You will get another benefit. You will reduce a taper relief. This table will be given to you in your exam, and it would be made available to you. So you would get access to this table. Now, what is this table about? That simply says, please see the period between the date of gift and date of death. If the period is beyond 3 years and up to 7 years, only then you will get the relief. So what is the relief? Let's say your IHT is 10,000. No lifetime tax paid was, let's say, 1,000. You still have 9,000 remaining. Now on this IHT, let's say your period between the date of gift and date of death is 5 years. Now let me tell you what is the structure looks like. If the period is between 3 to 4 years, the period is between 4 to 5 years, and the period is between 5 to 6 years, and the period is between 6 to 7 years. Here, if you have the taper relief will be 20%, here 40%, here 60%, and here 80%. So that means if let's say my period is between 4 to 5 years, so then I will get a taper relief of 40%. I will simply reduce this multiplied by 40. And this will be the reduction in the death IHT, and net only 5,400 will be borne by the taxpayer. Done. This is all about your death IHT. Let's take the next area, which is death estate. Then I'll take up questions to make you understand entire points. Okay. I think I can take the example now, and I will cover up the lifetime tax and death IHT, and then we will cover the tax on death estate. Okay. So let's just read till this point. Allow me a minute. Just give me 1 minute. Okay, now let's resume. Sorry for the break. Now let's resume. So now let's try this question and be absolutely clear about it. Let's look at this question, and I'm just going to solve the lifetime tax and death IHT part right now. When we cover death estate, I will solve the question for death estate as well. Jar diet on, just one more thing, guys. I've taken these questions, this question typically from your technical article. Okay, it was a very good question. So we covered a lot of questions in the class as well, from past papers, from technical articles, from study hub, from different other materials. We have our customized material. So here I have taken this question from your technical article. Now, Jar died on 18th March 25, leaving an estate which is valued at 450,000. The residence nil rate band is not available. I will cover this when we cover death estate. Right now, I'm just doing lifetime tax and death tax. She has made the following lifetime gifts. On 1st August 2016, a gift is made to the trust, and on November 22, the gift is made to the trust again. These figures are after deducting the available exemptions, so don't worry, we don't have to deduce any exemptions right now. In each case, the trust paid any IHT arising. That means donee has borne the tax. The NRB for 16-17 is given to you was 325,000 only, and 22-23 was also that. Let's calculate the lifetime tax. So here when you do it, first thing will be always to write the date of the gift. Very important is that you should be writing the date of the gift. Now what is the date of gift here? 1st August 16. So I will write here 1st August 16. The next date is 1st November 22. I will write here 22. Now this value is after exemption, but always write your tax here so that you know what exemptions, how will you give your annual exemptions. Okay, this gives you comfort. So here my tax year is 16-17, and here my tax year is 22-23. Okay, now that's all, and it is a CLT transfer. Please mention there. Now this detail that you write will make your life very easy. You will never be confused anywhere. Now please write here, this is the value after exemption, so that is my chargeable transfer of value. So I'll simply write here chargeable transfer of value. Now this value here is 200,000, because it says that this figure is after reducing exemptions, and this is 280,000. Now I will reduce NRB. Now what is the rule? In the first case, I will reduce 325,000 less any chargeable transfers GCT that was made in 7 years prior to the date of gift. Prior to 16, there is no gift made, so nothing is there. I will reduce full 325,000, but I cannot reduce that amount, otherwise it will create a loss, and we know we cannot create a loss, so I will just reduce 200,000 and make this amount as 0. So this is my taxable value. So this taxable value will now become 0. I hope I'm very clear on this. Let's go to the next one. When we take the NRB here, now I'll take 325,000 less GCT of the chargeable transfers that were made in 7 years prior to the date of gift. Gift is 1st November 22, 7 years when you take, it starts from 2015 onwards. This transfer was made in 16, and it is a chargeable transfer because it is a transfer to the trust. Chargeable transfer does not mean you are paid IHT. It means it is eligible where it can be taxed for IHT. So CLTs are always eligible for IHT. Hence, it's a chargeable transfer. So I will reduce the GCT, which here is transfer of value, is 200,000. Okay, so I will reduce from 325,000 to 100,000. So I will get here 125,000. Now when you reduce it, you will get here taxable values are 155,000. Now you know that, guys, when it is 155,000, so you will be paying IHT at the rate 20%. The reason being that it says that the tax will be borne by the, tax will be borne by the donee. Since the tax is borne by the donee, you will reduce 100 and you will tax it at 20%. So let's calculate the liability. So we have here 31,000 is the net IHT due. Clear, it is borne by the donor. Done. Lifetime transfer is done. Lifetime IHT. Now let's do the question on death IHT. How do you calculate death IHT? Simply see what is the date of death. The date of death is 18th March 25. What is the 7-year period? The 7-year period is, I will write here date of death, which is 18th March 2025. Okay, and 7-year period will be 7-year period is available from, so reduce 7 years, it is 2018. That means 19th March 2018 till 18th March 2025. This is the 7 years, right? Yes. Now you have here two transfers, 16 and 22. 16 is not falling in the 7 years period, so it is not subject to death IHT. 22 transfer is falling in it, so it will be subject to death IHT. Just see how do we calculate death IHT here. Okay, so again, my starting point will be the GCT. Now look here. Here your tax is borne by donee. So GCT is same as transfer of value. It will not change. It will be 280,000. Now you reduce NRB again. Remember that trust transfers are always chargeable transfers. You cannot always leave from it. So you will have the same NRB here like we had 125,000. That will not change. Okay, now again you reduce it. So on the same amount now, which is your taxable value, you will calculate death IHT. Death IHT is at the rate 40%. So calculate death IHT. Now from this, I will reduce lifetime IHT paid. Lifetime IHT paid, we have already calculated 31,000. I will reduce from here. Do we have any taper relief available? For that, minimum period between the date of gift and date of death should be 3 to 4 years. Minimum 3 years should be there. The date of gift is 1st November 22. Date of death is 18th March 25. So it's less than 3 years. Hence, taper relief will not be available. So simply the net IHT, death IHT payable will be 31,000 and it is going to be borne by the donee as the donor has died. So done. We are clear with lifetime IHT and death IHT. Let's understand about death estate. Then let's do 2 questions on it so that you are absolutely crystal clear on the same as well. So please look at my screen for the same, guys. Now when we see death estate, the estate means what all the taxpayer holds. So here I've given you just a summary of, so death estate will include all assets which is owned by the taxpayer, which is the donor, the deceased before the till the date of death. Okay, all assets. But you will reduce these assets by debts, only the debts which are legally enforceable. Any promise which is not legally enforceable will not be reduced here. Funeral expenses will be reduced here. Any transfer to the spouse or civil partner, that is an exemption, will be reducing your estate. Nil rate bands will reduce your estate, and RNRB, residence nil rate band, will reduce your estate. Now, what is a nil rate band? Nil rate band is same 325,000. But now here, when you take the 7-year period, you will not take before the date of gift because it is a death estate case. So in the case of death estate, you will reduce NRB by the GCT of the transfers made within 7 years prior to the date of death. Clear? Very important. Now, one more point for NRB that I want to tell you here. The NRB will be of the deceased person himself or herself, plus if the other spouse or the other civil partner has died before this spouse, that means first spouse has already died and now the second spouse dies, then for the first spouse, if there is any NRB that was not utilized because the estate was already covered by the partial NRB only, then that NRB which is unutilized will be used for the second spouse as well. Likewise, there is one more NRB here which is known as RNRB, Residence Nil Rate Band. Residence nil rate band is simply a nil rate band available when the donor or the deceased transfers the main residence to the lineal descendants. Descendants means children, grandchildren, and so on. Clear? So if the main residence, which is a part of the estate, is transferred to the lineal descendants, then additional RNRB is available. What is that additional rate band? It is the lower of 175,000 or the value of main residence, and if there is any direct debt which is relating to that main residence, you will reduce that debt and get the net value of the residence. So net value of the residence or 175,000, whichever is lower, will be allowed as additional nil rate band that we call as residence nil rate band. Clear? Again the same rule, if the first spouse dies already and now the second spouse has died, then whatever is the remaining unutilized portion of RNRB for the first spouse will be given here and added to the RNRB of the second spouse. Also, if let's say there was no main residence in the estate and no main residence was there, so no RNRB was claimed by the first spouse, here when second spouse is transferring the main residence to a lineal descendant, then additional 175,000, which is like free of cost, is available to the second spouse. Okay, so double RNRB, double NRB can be made available. Absolutely. Clear? Done. So we are done with the basic understanding and the complete detail of your IHT. Now I think it's the time that I do questions. 2 questions I'll take up for death estate. So just look at my screen and I'm taking 2 questions for death estate. First, we are just going to continue this only and then I will take the next one. Okay, let's do the question. So the same question I'm doing now with the continuation. Let's calculate the tax on death estate also. Tax on death estate is also at the rate 40% only. Now, Jar died here and leaving an estate valued at 450,000. So here I will calculate death estate. I can just do it here as well. So here this was a lifetime tax. This was a IHT. And now let's calculate tax on death estate. So here I will take the estate value. Estate value is given to you 450,000. Now it says that the RNRB is not available because probably the main residence is not part of the estate which is transferred to lineal descendants. No other information is there, so we'll just reduce NRB. NRB will be 325,000 less GCT of the chargeable transfers that are made in 7 years prior to the date of death. Now, in the 7 years period prior to the date of death, we just have one transfer made, and which is this transfer. Okay, what is the GCT of it? GCT is 280,000. So here also NRB will be reduced by 280,000. Okay, now take the net NRB. So the net NRB is 325,000 less 280,000. We get here 45,000. Now reduce this value and get the taxable estate value. So taxable estate value is 405,000. Okay, this is the taxable estate value. Clear? Now what you will do, just calculate death IHT, or that is tax on death estate. So tax on death estate is this multiplied by 40%, which is 162,000. Done, clear, and it will be borne by the personal representatives of the donor, that is a deceased person. I hope personal representatives of the estate, that we typically call them. So I hope now it's very clear. Your IHT is absolutely crystal clear and as smooth as icing on the cake. Clear? Now I think it's the time that we take up the next block. So the next block is corporations, where we are going to cover TTPs, corporation tax, losses, chargeable gains, groups, everything. So let's discuss that question. But I think before that, I have one more question that I had actually done and taken. So this was a question that I intentionally took, where we'll do the IHT calculations and the CDT calculations. Okay, just to give you an idea that if you have a CDT also asked and IST also asked, how would you do that question? So let's quickly do this question and then we proceed to corporations. Okay, so let's take up this question. On 20th June 24, Craig made a gift. Craig made a gift to his grandson of a residential property which is valued at 250,000. Okay, and the gift of the property resulted in a chargeable gain which is given to you 145,000. The value of the property is expected to increase to 300,000 by December 26 and to 340,000 by December 31. Craig is an additional rate taxpayer. He will not make any other disposals during the tax year. So that means he is not having first any BRB available. Second, he will have AE available for the tax year 24-25, and he has not made any previous lifetime gifts as well. Craig has an estate valued in excess of 200,000 for IHT, for 2,000,000. Okay, for IHT purposes. Okay, fine. So first let's calculate the chargeable gain tax. So here it's very simple calculation of CGT. So you will have chargeable gains which is already given to you here 145,000. You will reduce AE less 3,000. So you will get your taxable gains 142,000. It's a residential property. So we will have CGT applicable at 24% as he is an additional rate taxpayer. So no BRB is available. Done with your CGT part. Simple and easy. Let's go for your IHT part. So we just have to calculate the IHT. Now, why this value is given to you? Is it not going to increase your estate value? It is definitely going to increase your estate value. Okay. Okay, the property value was 250,000, and Craig, when did Craig die? No, Craig is alive only. Okay, so here we'll not have death estate tax calculated. The question is, so here we'll not have IHT liabilities only. Yeah, so better leave this because there is a bit of a portion that is relating to ATX. So let's not do it. Just let's do the calculation of CGT liabilities only. Okay, so leave this portion here. But however, we can have a tax saving part calculated here, because if we will have a tax saving part, yeah, that we can calculate, that we can discuss also. So the residential property was 250,000 and we are doing the valuation on 31st December 24. So on 24 your value is, no, June 24 the value was 250,000. Then on December 26 the value increased to 300,000, correct? So there is an increase of 50,000 here. So increase in value is 300,000 less 250,000, right? Yes. Now you can see that just because the property was gifted at the time of when the Greek made this transfer, that time the property value was 250,000. After 2 years, the property value got increased, but then that's not going to impact Craig, right? Why? Because he's still alive and there's value, the asset is already been transferred. So if the question asks you what is the benefit here, the benefit is that simply you apply 40% 20,000 is the tax saved, because if he would have died, then this would have become taxable, and then there would have been a death IHT applicable on it at the rate for 20%, 40%. Right? So 20,000 is the tax saved that we can comment here. Clear? Okay, let's go to the next one. So guys, now let's start with TTP calculations and understand about the corporations. For that, first thing that comes here is, ma'am, what is a corporation? You know, corporation is an incorporated body, which is an artificial legal person. Second thing is, ma'am, here when we calculate TTP, will it make a difference? Will the corporation is a resident or a non-resident? Yes, it would. So let me first make you quickly clear with this understanding of how do we determine the residential status of a corporation. To determine the residential status of a corporation, we need to first see whether the corporation is registered or not, because where the corporation is registered. Because if a corporation is registered in UK, then it is always a resident company, always. Okay, when a corporation is registered in UK, then it is always a resident company. When a corporation is registered outside UK, then it will only be a resident company when it is centrally managed and controlled from UK. Okay, centrally managed and controlled means the directors' meetings, decision making, policy formulation, everything is taking place in UK. So if in that case only it will be a resident in UK. So only when the corporation is registered outside UK, managed, centrally controlled outside UK, only then it is a non-resident for tax purposes. Second, if it is a resident corporation, then the entire worldwide income is put to tax as per the UK tax rules. If it is a non-resident corporation, then only UK income will be put to tax as per the tax rules in UK. Okay, now the next pointer that comes in, ma'am, do we also follow the tax year basis for corporations? No, we do not follow tax year basis for corporations. We follow cap here. Cap means chargeable accounting period. We follow concept called chargeable accounting period, that is strictly going to be a maximum up to 12 months and it will never go beyond it. So if the entity's period of account is going beyond 12 months, let's say for 18 months, then you will prepare two caps, first cap for 12 months and the next cap for the remaining 6 months. Clear? Absolutely great. Now, when we do cap, then comes the question, ma'am, how do we determine what is the cap period? Remember, guys, your cap will start from the start of trade, earliest of these dates, start of trade, or the end, one at the day after the end of the previous cap, or when the company becomes liable to the corporation tax liabilities or corporation tax. So basically, earliest of this date will be the start. Now from there, you can take 12 months, or you can take end of cap, or you can take when the trade is ceasing, the company is going into liquidation, administration, there is a session which is taking place. So, but in any case, this period cannot exceed 12 months. And very important, the date of incorporation is not the start of cap. The start of trade is the start of cap. Very, very important point. Okay, now done with this. Now comes me, I'll take up the portions one by one, but before that, I think quickly I can show you what is the performer of TTP. So just give me a minute and I will show you that performer here. Okay, now let's see this performer here, everybody. Please look at my screen. When you see the performer, we will prepare the cap for a particular number of months, right? Typically, it is for a year, which is 12 months. If it goes beyond, you have to make it into two caps. So the performer goes like this, where you start with your trading income, where you take the adjusted profits, just like we do for individuals, we'll do it in the same way. Whatever are the changes, I will tell you here right now. From there, we will reduce our capital allowances and we will get trading profits. And always by default method for corporations is accrual basis, right? We never follow cash basis for corporations, we follow accrual basis. Then we will, with this, we will add other income like interest from the non-trade loan relationships. Typically, interest income, that is a net interest that you earn from the non-trade relationships, like you have invested money into shares and you are earning that interest. Then property business income, again you will follow accrual basis only, and any accrual basis, whatever is the income arising, you will add it here. And remember, corporations always have commercial properties, they do not have residential properties. Now miscellaneous income, again any income which is other than the income that we have listed above, like patent royalties received for the trade business, so will be added here. Dividends income is never taxed for corporations, so we don't add in dividend income, neither we reduce dividend expenditure. Then net chargeable gains will take up, because we will adjust this with their own in-house capital loss. Once you have all the once you have all the incomes, then you get a total, and that total is called as total profits. From total profits, you will reduce just one thing, which is known as qualifying charitable donations. What are these? I will explain you. And these qualifying charitable donations are always reduced on a payment basis. Only when they are paid, they are reduced. Finally, you will get your TTP, which is taxable total profits, on which we apply corporation tax and pay taxes. Clear? Okay, now I will just discuss these pointers one by one. So first, I am taking the trading income part. Uh, let's do one thing, guys. We will do the corporations and the complete part. Just let's take a 5 minutes break and then let's do it. Okay, I'll just take 5 minutes break, and when we continue, we will complete and understand this complete TTPs and the other corporations. So let's resume in 5 minutes. Yes, guys. So I think now we are good to go, good to resume. Okay, everybody look at my screen quickly. So now we had just started with the discussion of the performer and we completed with the discussion of the performer for the TTP for corporations, wherein we understood about how do we create that performer, which is mandatory to be followed. When you are appearing for your exams, you have to do your corporations question exactly in the same performer. Now let's understand everything part by part and let's just quickly revise them. Number one is when it comes to the trading income calculation, everything else remains same, just like individual trading income calculations, few changes. Number one, by default basis is accrual basis. Number two, the qualifying donations, just like individuals, you will take small and local. The only difference is the donation which is not small and local will be allowed as qualifying charitable donations when we calculate TTP and we reduce it from total profits and only on payment basis. Number three, there is no personal expenses for a company, so no disallowance of personal expenses will be there. Number fourth and very important, that capital allowances, you will just find a bit of difference because for capital allowances for corporations we have some additional benefits. So I will just quickly take up that additional capital allowances rules. Number one, see, till tax year 22, yeah, till tax year 22-23, that is up till 31st March 23, we had a rule where the corporations were allowed two additional allowances apart from AIA, FIA, small pool WDA and the WDA. These two additional allowances were in case the new plant and machinery is bought and it is bought for a main pool category, 130% of the cost of plant and machinery was allowed as an allowance and we would call it a super deduction. Number two, if the new plant and machinery bought is of a special rate pool category, then it would receive an additional allowance of first year allowance. So the special rate pool category new plant and machinery purchased by a corporation would receive first year allowance at the rate 50%. So typically what we used to do was first we would adjust 100% AIA against the special rate pool purchase, and then also if there is any purchase amount purchased remaining for the special rate pool, right, the asset value still remaining, then for that value we would adjust 50% FIA. But the beauty of this allowance was that when you give 50% FIA to special rate pool, the remaining 50% will not enjoy WDA. So this remaining 50% will be added to the total special rate pool after WDA. Let's quickly see what I am saying. Let's say the value of the special rate pool purchase was 1500,000, that is 15 lakhs. Now from 1500,000, I gave 10,000 of AIA. Now what I'm left with? I'm still left with a special rate pool planting machinery value of 500,000. As per the rule that we followed till 31st March 23, 50% FIA was available. Okay, that means again an allowance only. And this 50% FIA would mean that you would simply take 50% and add it to the allowances. And the remaining 50%, that is here 250,000, it will be added to the special rate pool after WDA, because on this value in this year you will not receive WDA. Done and clear? Your question is, ma'am, why are you telling me a story that was there before 1st April 23? Because now the repercussion is here. Let's say you sell this property now, you take the disposal of it. So you will follow the same rule. You will take lower of disposal proceeds and the cost. Once you get the disposal proceed, if this is the asset on which you had claimed earlier 130% capital allowance of super deduction, then you will simply take, let's say that the disposal proceeds are 10,000. The lower of disposal proceeds or cost is 10,000, and this is that value on which we had taken 130% super deduction earlier at the time of purchase. So now in the capital allowances column, you will reduce this amount because this will reduce your capital allowance, as we will treat it like a balancing charge. Okay, so I repeat, an asset on which we had claimed super deduction earlier, if it is getting disposed in the current tax year, which is your testing area for the exam, so then the 100% value of it will reduce your capital allowance and we will call it as a balancing charge. Next, if the asset that we are disposed of is, let's say, is a special rate pool asset on which we had just claimed 50% FIA. So the disposal proceed is, let's say, 10,000. When it is a special rate pool, then 5,000 will reduce from special rate pool and 5,000 will reduce from capital allowances. So that means on the asset on which we had just claimed 50% FIA, only 50% will reduce your capital allowance and the remaining 50% will reduce your pool balance. Done and clear? Great. Okay. So this is about your disposal proceeds that are relevant for the current tax year. Now one more rule has been inserted for current tax year, that is enhanced capital allowances for the corporations. So again in tax year 24-25, enhanced capital allowances are introduced only for corporations. But the difference is that here we'll not have 130% super deduction. It simply says if a new plant and machinery is bought in 24-25, then just like AIA gives you 100% benefit on the cost, here also you will have 100% first year allowance on the main pool purchase. So the name has changed to first year allowance 100%. You will still have AIA, don't worry for that. But for main pool purchases, you will have additional allowance of 100% FIA. Now, if it is a special rate pool asset, it is same, you will get 50% FIA. So the treatment like we did here in the example, you will do it in the same way. So remember, when you have annual investment allowance, you will first adjust it against special rate pool and then the remaining balance, if it is there for that plant and machinery that you have purchased, then you will give 50% FIA. And a new plant and machinery purchased for the main pool asset will enjoy 100% first year allowance. Done and clear? That is the only new adjustment that you have for capital allowances, the disposal of those, the enhanced allowances that you took earlier, those assets are disposed of and new enhancement allowances are introduced for the current tax year. Done and clear? Great. Now we are done with trading income differences that you have for the capital of the corporation. Second, let's see for Let's see for the second heading. The second heading is non-trade loan relationship. That simply says the non-trading loan, like loan taken to invest into shares. So you're earning interest. So any income that you earn, less any expenses incurred, the net interest amount, you will add it under this heading. Non-trade loan relationship. Okay, interest income from non-trade loan relationship. Now, the next is property business income. Same rule like individuals you will follow, but understand it is a commercial property. Since it is a commercial property, you will have full finance cost. No, I'm sorry. You will have full finance cost allowed, but then that finance cost will not be allowed as a deduction from property income. Then where will we take it, ma'am? That finance cost will be shown under non-trade loan relationship. Okay, and so I will just repeat this point. In case of an interest payable on loan to buy or improve the property will be reduced in full, but under loan relationships and not under property business income. Okay, so that will be, if it is non-trading loan, then you will reduce it from the non-trade loan relationship. Clear? Which is typically non-trading loan, because property income is an investment income that you do. Done? Third difference is that here you will follow by default accrual basis, and one of the major differences, the property losses that you have are like the free losses. That means now property loss will be used first against the total profit. So when you have total profits, you will first reduce property losses and then only you will reduce the trading losses. So unlike the individuals, it's a freely available loss that will reduce your total profits of the current tax year at the current cap, and the unrelieved property loss can be carried forwarded to be used against the total profits of the future cap. Done? Good. And now when we study in the groups, we will study that the excess property loss will also be benefited under group relief. So that I will cover in that chapter. Now let's go to miscellaneous income. That simply says dividend income is not taxed for companies. Neither a dividend paid is allowed as an expense. And the miscellaneous income is like the patent royalties that we receive for the non-trading part. Okay, now net chargeable gains, the same rule like individual will follow, no changes. There are changes in shares and securities, and one difference is there that I will cover in the chargeable gains topic. And one more important point, the corporations, they pay they pay corporation tax on it. They don't pay the CGT on it, right? So here we just have one tax, which is corporation tax, which is calculated on the TTP. Done and clear? Great. Okay. Yeah, now let's see this. So we are done with the net chargeable gains. Qualified charitable donations, I've already explained to you. The donations which are not small and local, because they would be allowed as an adjustment when we calculate trading profits, correct? So all the other donations allowed on a payment basis strictly here. Now, when you notice, so the TTP structure looks clearer. Let's go back to the format again once, and then I will tell you about the corporation taxes. So now here is the format. You calculate trading income by taking adjusted profits less capital allowances. You will get your trading profits on an accrual basis, and then you add with it other income like the interest income from the non-trade loan relationships. Finally, you will add the net chargeable gains, you will add miscellaneous income, you will add property business income, and then you will get total profits from which we will reduce the losses, and then we reduce qualifying charitable donations to get the TTP. Once you have the TTP, comes the next point, ma'am, how to calculate corporation tax. So please look at my screen. We have a different way to calculate corporation tax. So we have basically three tax rates applicable when we calculate corporation tax. Number one is, and here we will take the concept of account augmented profit. On augmented profit basis, we will decide the rate applicable. I will cover it, don't worry. Main rate is the tax rate which is applicable if your augmented profits are. Okay, so main rate is the rate which is taxation at the rate of 25%. Wherein corporation tax will be calculated at the rate 25%, and that is calculated on that is calculated when your augmented profits are more than 250,000. Augmented profits are more than 250,000, then directly a corporation tax rate of 25% will apply on the TTP. You always pay tax on TTP, but what rate it is going to be, that is determined with the help of augmented profit. Next, if your augmented profits are up to 50,000, then this is known as the small profit threshold, and then a tax rate of 19% will apply. If your augmented profits fall between the small profit threshold and the main rate, that is the upper limit, that is simply the lower limit and the upper limit, if it is falling in between, then we have a different method, which is either we calculate the taxes by marginal relief method or marginal tax method. Understand that the marginal tax is the highest tax rate applicable, which is 26.5%. So 25% is the main rate, lower limit or the small profit rate is 19%, and in between when you have the marginal tax rate is 26.5%. Clear? Great. Now, how do we calculate augmented profit? Augmented profit, look at my screen, is simply the total of the taxable total, sorry, that is simply the total of TTP. Okay, it is simply the total of TTP. So augmented profit is equal to TTP plus dividend that we receive from non 51% group companies. What does this mean? Let's say when we create a group of the companies, that is a parent subsidiaries, and we create a group, subsidiaries are there, wherein the relationship is not 50% and dividend is received from those companies where the relationship is not more than 50%. That means the investment percentage is not more than 50%. Then those dividend we will add with TTP, and this is just to calculate the tax rate. Just to know the tax rate, know where we will use augmented profit to calculate tax liability. Tax liability is always calculated on TTP only. Clear? So you will see the augmented profit, and then only you will decide the threshold, well, the tax rates. Let's say your augmented profit is 300,000, then you know the tax rate is 25%, and that you will apply on TTP. If your augmented profit is 30,000, you know the tax rate is 19%, so that you will apply on TTP. Clear? If your augmented profit is, let's say, 100,000, now you know it is between the upper limit and higher limit, correct? Upper limit and lower limit, correct? So then we will apply the marginal relief method or marginal tax method to calculate the tax. That I will show you in an example, don't worry. Last point for corporation taxes is just understand that if an entity has associated companies, what are associated companies? The companies with which the entity has at least 50% of the relationship. So let's say there is an entity A, there is an entity A, there is another entity B, there is another entity C, another entity D. Okay, now this entity also has one more entity which is E. Here we have F, here we have G. Okay, now let's see the percentage of holding. Just 1 minute. Okay, now let's see the percentage of holding. So the percentage of holding of A in B is 80%. Just 1 minute, guys. I'm facing a glitch. Just give me a minute. Yeah. Okay, now the percentage is 80%. There's some glitch taking place, guys. I think okay, there is some glitch, guys. So in that case, I think I'll have to stop the stream right now. I will just restart. Okay. Yes, so everybody again, I have resumed again, and let's be with me on my screen. Okay, so now here I was discussing a case just to make you understand about the concept called associated companies. So just look at my screen. I am taking a main company, which is a main group company, which is A. Now A has got some subsidiaries, which are entity B, entity C, and entity D. Now, A's interest or A's percentage of investment into the shares of entity B is 80%. A's investment into C is 70%. A's investment into D is 100%. B has got further a subsidiary of 75%. C has got a subsidiary set of F and the percentage is 80%. And D has got the percentage holding in G as 60%. Now you have to see, now let's see, this is not this, this is 51, 55%. Okay, now, so who all will be a part of this company group when we have to check for the associated companies, we have to have a basic minimum relationship of 50%, direct or indirect. What do I mean by direct? Direct parent subsidiary relationship. Now we are looking for the group A, group for company A, that is the main parent company, that is known as the ultimate parent company. Now company A's investment into B is 80%. So B is a part of the group because we need minimum investment to be 50%, which is holding true here. Now next we will look for C. When I look for C, my investment is, now when I look for C, my investment is 70%. When I look for D, the investment is 100%. Okay. So A to B, it is more than 50%. A to C is more than 50%. A to D is more than 50%. So now I know that A, B, C and D, so far they are a part of the same group. Correct? So far they are part of the same group. I hope everybody agrees with this. Those who are with me on the screen, I'm sure you are agreeing with this. Okay guys, now moving to the next one. So now we have the next relationship. The next relationship is A to E. Now we have to see the direct, indirect relationship between A to E. So how do we see it? Now A's investment in B is 80. What is the investment in E? So you will multiply 80 with 75%. You get here 60%. So A's net investment in E is 60%. That we say that effective interest in E or indirect interest in E. Since this is also beyond 50%, so when we make the group companies where I'll have A, B, C, D, E will also be a part of associated companies. Let's see the next one. What is A's effective interest in F? So 70 multiplied by 55%. You get here 38.5%. Now, is it more than 50%? No. So will it be a part of associated company? Will it be a part of the group when we're checking for associated companies? No. Because effective interest of A in F is less than 50%. Let's see effective interest of A in G, which is very clear, 60%. Now, is it more than 51? Is it more than 50%? Yes. So it will also be part of the group that we will take to calculate the number of associated companies for the purpose of corporation tax. Okay, I will tell you the relevance here, don't worry. So here I will add G also. Okay, now what are the number of companies that are forming this group? 1, 2, 3, 4, 5, 6. It simply means when you know the number of associated companies, please divide your limits by this amount, by this number. So now your upper limit revised would be 250,000 divided by 6. Lower limit revised will be 50,000 divided by 6. And these revised limits will apply to all 6 of these companies. Clear? Few more rules for associated companies. Number one, it doesn't matter if a company joins the group or leaves the group in the current cap, as they will be counted as if they have been there for the full cap. That means they will be counted for the number of associated companies. Number two, dormant company, if it is there, any of the company is a dormant company, then that will not be a part, that will not be included in the calculation of number of associated companies. Number three, if there is any non-resident company, then that can still be a part of number of associated companies. Okay, clear? Clear with this? Yeah, that's great. So now let's look into the next question and let's try to solve it. So now we're done with the complete TTP calculations. Let's do the workings here. So now here I've taken a question, very good question that will help us understand about the TTP concept quite in detail. So it's about W companies preparing its accounts for 31st December each year, and the statement of P&L. The statement of P&L is given to you here for the year ended 31st December 24 is given to you. That's okay. So now when we move forward, let's see the requirement of the question. The requirement of the question is to calculate TTP, but I will also calculate corporation tax here so that you are clear with the concept of corporation tax as well. Okay. Now, so here we have to do the calculation of TTP. I will write the heading as calculation of TTP. Okay. I'm sure guys, everybody is with me on this. So now we are doing the calculation of TTP. So now here I have, well, my starting point will be, the question is guiding you for the same. Don't worry. The question tells me all these details are there, but let's look at the last point, which is generally the point where it tells me to calculate the starting point. Starting point otherwise is same, like individuals will start with the net profit only, because you have to calculate the adjusted trading profits. So here I will have what, I'm sorry guys, but I think I'm still facing some glitch. Just give me 5 minutes. I'll stop the stream for just 5 minutes and I'll just try to fix the glitch and come back. Okay, just give me 5 minutes. Sorry.